And I'd love to start out with this group just with a pop quiz. When we think about preparing for the credit downturn, if you could just describe in one word where you think we are now or what the environment is now. And maybe we'll start with you, Richard.
One word?
One word, yeah.
Okay, going to betray my age at this point. My one word is again.
You want to elaborate on that, or?
Happy to. So yeah, I've been through several of these. I was doing Eric's job in 2007, 2008. Have seen it before. They're all different, but they're also all the same. So I think this time, I think the outlook's probably not as bad. I know Benjamin Tao on Tuesday at an event was saying he was looking at Bank of Canada starting to raise rates next year, which sort of indicates he doesn't think this is a prolonged downturn. I think the degree of uncertainty and volatility on this time is big. Obviously, the tariffs and trade, the wars, the impact that has on the resource economy, all of those pieces make it highly volatile and unpredictable. But at the moment, it's looking, it's a downturn, but it's not going to be prolonged or very deep, I hope.
Yeah, makes sense. Eric, what's your word?
I think my word would be historic. I feel like our future selves, 5+ years from now, are going to look back at this time and the lenders that were smart will have used it to collect a lot of data and learn a lot about where the good lending is in a credit downturn and where the bad lending is. And Canada, fortunately, hasn't had a lot of these, but the downside of that is you just don't have a lot of data to say, like, when things go south, what's the type of consumer that's resilient? What are the type of products that are resilient? And so I'm excited to be through it and then excited to see how to capitalize on the learnings from that as well.
Awesome. What about you, Jeanot?
Cool. Well, I think the word I would go for is probably okay. Like, this isn't a terrible crisis like you had in sort of 2008, or a sudden crisis like you had in sort of late 2022 when you had the massive inflation shock post-COVID. It's really been a bit of a slow burner that I think we've all seen coming, especially in Canada, I guess, for the last kind of 18 months, or since we started Karoo and since Trump came to power. And I guess what that means is it's an interesting crisis from a lender's point of view, especially for us, because you can kind of adapt in real time and prepare and modify your kind of credit policies kind of in anticipation of something that's like definitely going to happen and an environment that's definitely going to get more challenging over the next few years. Yeah.
Makes sense. So, I mean, the last year has been really interesting from a credit perspective with, the tariffs and inflation and now the war. So I'd love to hear from each of you. Just how do you think lenders, with all this going on, how should they be thinking about their playbook and preparing for the credit downturn, both like in the short term and also in the medium term? Maybe I'll start with you, Richard.
Yeah, I mean, I think the first thing that, a lot of risk professionals in this room who know this, but the thing we keep having to tell our colleagues is almost all the loans that are going to go bad are already on the books. I mean, it's too late. You book the people who are going to go bad, and they will go bad. So what you can do at the front end in terms of acquisition, obviously don't do anything stupid, but there's a limited amount that your acquisition strategy is going to change. And I think the contrast probably between what Eric has to do and what Jeanot and I have to do is we're still in growth mode. I mean, whatever's going on in the economy, Neo is looking to double the size of its business every year, and we're still trying to do that. So acquisition has to continue at pace, and so there's a certain amount you can do around being conscious, especially things like geographic concentrations. Be a little cautious around those. The evidence is they haven't been as predictable as you would have thought, so it's not easy to say, oh, well, it's all concentrated where the tariffs hit or where they don't. It's not been as obvious as that. In terms of the other actions you can take, therefore, is your account management actions around early identification of high-risk accounts, early treatment of delinquency, all of those pieces, just require that extra bit of attention and that extra bit of focus. Like I say, we've been through this before, and so much of what we have in place by way of account management strategy, delinquency, all of those reflect the need to respond to circumstances. So yes, heightened awareness, but fundamentally, we should all be continuing to run with the strategies that we had in place. If you think this environment requires something radically new, you probably weren't doing the right things to start with.
Yeah, and I know, Richard, your word was again, but I know also every downturn is a little bit different, and you mentioned like different geographies. Anything, we've also seen different products, like I think personal loans has gone up quite a bit, and credit cards have been a little more resilient. Anything you've seen in terms of how this downturn differs from the last one?
I think, again, the geographies have been slightly different. I think the real spike in consumer proposals, so accelerated charge-off from bankruptcy or consumer proposal, we've had the last few months, we've seen a sharp spike there, particularly in consumer proposal. That obviously is always challenging to deal with because they frequently are genuinely surprise losses. I mean, people who have been current up until the point at which they charge off. So that's not a feature that was as prevalent on previous occasions. I think it's a reflection of how that particular market has developed, and so people are, have access and are more aware of the opportunity. I think the dog that hasn't really barked is mortgages. So we know there's a whole load of mortgage repricing, which happened in 24. There was less of it 25. There's another wave coming this year. Sometimes I think I see evidence of it, where you see at the higher end of our book in the prime plus super prime type customers who start to be delinquent, and it's not maybe doesn't rank order well, and maybe that's because they've been hit with they have a mortgage and they're suffering from that, and they're not paying us. But I have to say we haven't seen conclusive evidence of that, which, given that the mortgage lenders are basically doubling people's rate at renewal at the moment, is surprising, but it's maybe it's still yet to come. But
excellent, great. And now, Eric, I know as the only one up here of a publicly traded company, you're under strict requirements, but maybe just not RBC, not your playbook, but just in general advice for the audience on what we should be doing from a playbook perspective.
Yeah, when the risk metrics start to move, it's a good opportunity to spend time with your business partners, educating them on, hey, do we really understand the risks that we're taking? Let's really look at the margins and some of the decisions that we've made over the last couple of years and really try and quantify the risk. And then the next thing we work with our business partners on is, are we getting paid for that risk, right? And under the various scenarios, is that the kind of client or risk that we're going to be building our franchise around, or that we're going to want on our books long term? And so when risk was really, really low, that conversation wasn't necessarily at the forefront, and people were prioritizing different things with their time. But now that's at the forefront, and so we're really making sure that we have and taking the opportunity to have conversations with our business partners on that. And the other thing we're prioritizing is reminding people about the foundational investments to make on the risk side. I know Becca was up here earlier, and a bunch of others in the panel were talking about talent and data. And so really what we're pushing a lot in this environment is, did we have the team in place to respond to this? And did we have the data and infrastructure to respond to this? And I think we're being a little bit more introspective and trying to understand maybe we hadn't invested in that in the ways that we wanted to. And so we're using that opportunity to really push and get the buy-in for those investments going forward as well. And so a little bit similar to the playbooks you're running, but just using the opportunity to talk about, do we understand the risks? Are we getting paid? And, here's the long-term investments we want to make in this team. And let's get the funding and get momentum on it.
Yeah, you mentioned business partners, Eric. It's interesting because I think timing is so key when it comes to preparing for the downturn. But being a risk professional can often be a lonely world, right? Like, it's hard to get
Like when risk is good, why did you exist? And when risk is bad, why did you screw it up? And
Exactly, 100%. And like the best time to prepare for the downturn was yesterday, but the next best time is today. And like, how do you build that business case and kind of convince the organization who has their own growth goals and all of that you need to take action?
The success we've had is around like understanding the cash flows of the client. And hey, these cash flows temporarily looked good, but they weren't resilient as kind of risk turned. Right. And so turning the risk conversation into a P&L conversation has been quite helpful, because that's the language that all the P&L owners speak, sure. Right? Yeah. PCL is a part of it, but really helping them understand the risk revenue return.
Right, excellent. Jeanot, what about you?
So when we think about kind of like preparing for the downturn and, and what we do, I guess like coming back to what I was saying earlier, there's a couple of things. So this has been a bit of a slow burner. So you can kind of like adapt in real time. The other thing I would say is that we're a near prime focused lender. And when you're underwriting a near prime customer base, there is an inherent level of stress that population faces, even in benign economic times. And so we, I guess, view this kind of environment as a bit of an opportunity, because ultimately it means that we can still grow underwriting a customer type that the severity of how they're affected by this environment is not kind of relatively as bad as it is for a prime customer. And then also, hopefully, I guess take some market share from lenders that are more prime focused and are having to pull back on risk. Ultimately, I think what you see in these environments, especially in downturns, is the most vulnerable customers, where you have the biggest severity of kind of like how they underperform versus expectations, actually tend to be those who have high incomes, prime credit scores, and high debt loads, because if they have an employment shock, it's very hard for them to recover. So yeah.
You make a really, really good point, because I remember back in 2008, I was the chief credit officer at Capital One during the Great Recession, and Eric was graduating university and joining the team, and we definitely saw a much higher beta. Like our best customers, the highest FICO scores had the biggest shock, and those subprime, you could say, are always kind of in a recession, had a much lower beta. Eric, anything you remember from that time, or?
Lots of things. I think Richard, your word was again, like the key way to underwrite clients hasn't changed. Like from my understanding, like the people that went bad in 2008 are very similar profiles, and the bad characteristics and the good characteristics and the good lending and bad lending is reasonably consistent. It's just a matter of reminding people that even though you've had a run of 20 years of good lending, that doesn't, like those loans are on your books for a long period of time, and that recession no one ever sees it coming. I mean, maybe this one was a little bit more foreseeable, but I don't think people thought the unsecured, I think people thought it was going to be more the secured lending that was going to go bad, like mortgages, and it's more the unsecured that's going bad, and I'm not sure if, if you were to rewind, that's how people thought it was going to play out. But generally the characteristics of good lending and bad lending have remained consistent, at least as far as I've been looking at it. So yeah,
no, it makes sense. So it would be a panel in 2026 if we didn't talk about AI. And so, for you, because I don't know if you guys know what Karoo is doing, but really you're building an AI native company and scaling with, like, I was joking at the start, but only kind of half joking, right, with you and Ollie. So I'd love to get your perspective on, there's lots of AI use cases in collections, in underwriting. Some are kind of nascent, some are actually adding value now. Get your perspective on where you see the most useful use cases.
Yeah, sure. So I guess what does being kind of like a full stack AI company actually mean? I guess it means that, we don't just use, we use AI in like underwriting. We use it to process kind of cash flow information much more efficiently than you would be able to do with people. And also it allows you to kind of do that kind of deep, what we would term like artisanal underwriting on very small loan sizes of like $1,000 or a $500 credit card, which wouldn't normally be possible. But it also means that we kind of use AI throughout the entire business. So we we use AI agents to build our tech platform, which is all proprietary. We also have, what's really cool, especially when you think about in the downturn context, is a very small business like ours would have a very limited credit function and a very limited analytical capability if you were to look 5 years back. But actually, we have a whole kind of AI credit function where we can get all data almost instantaneously on kind of loss rates and risks as they appear in our portfolio, and have this really comprehensive picture of what's going on that we wouldn't have been able to have in the past without AI.
Right. And I know when we were talking, you had some really interesting thoughts on AI and how it's displacing jobs and impact on unemployment, and how that might also factor into stress on the consumer. So any thoughts on that, Jeanot?
Yeah, so I think that comes back to one of the things that I was saying before about the most vulnerable customers, especially in a downturn, being kind of people who are high income, high debt, high credit score. And I think it's a very underpriced risk in the medium term that you're about to have a ton of AI-related disruption in the jobs market. You have especially whole categories of professional jobs that can be very, in some cases, very easily replaced by AI. And folks who are affected by those layoffs, I think, will struggle to quickly find positions of kind of that are similar and allow them to service their existing debt load. And so I think it's something I don't have a very good answer of how you can you should underwrite this, and try not to be a sort of AI doomer. But it probably is something you want to think about sorry. And actually, one of the ways that I think about it is not so much around, I think that people spend a lot of time being oh, should I be underwriting the type of job that can be automated away? I think actually a lot of jobs can be kind of automated with AI, and it's probably more important in the medium term to look at the person's employer rather than the job type. If somebody works for the government, they are less likely to lose their job very quickly versus somebody who's working at Meta, as an example. Yeah.
No, that makes sense. How about you, Richard? I know Neo, you're very tech forward. You guys are always, dabbling and experimenting with AI. Where are you seeing the biggest use cases right now?
Well, apart from the fact that a much larger number of my team members are called Claude than used to be, we use AI in all the obvious places, building models, driving that innovation. I think, again, as a very fast-growing company, the way in which AI is driving productivity of our engineering teams is a source of challenge, just because the speed at which they can now generate new products and new features and actually get stuff implemented. There's part of that which is great. They manage to do stuff and deliver it more quickly, but it also means the sheer volume that we actually have to absorb is challenging. I think the other thing that I worry about, again, as a medium long-term risk, is actually back to the talent question, which is the feeling that the jobs I probably spent the first at least 5 years after graduation doing were jobs which could now fundamentally be done by AI. And the question which somebody asked me when I said that was, yeah, but could you do the job you're doing now without those 5 years? And the answer is probably no. So as we worry about talent and, Neo is hiring, we need people, please. But where do you get people with that good grounding and experience of having actually done the work themselves if the most basic analytical jobs are all being done for AI for you? And I think that's something that concerns me. I'm not sure it's AI can't do it all itself, so we still need people at the analyst level, but they're doing something slightly different. And whether that means they gain the right experience or not, I do worry how we're going to fill that talent layer going forward.
Yeah, very good point. When we think about a playbook or preparing for the credit downturn, I think there's two dimensions people usually talk about. There's where we're at right now, should we be tweaking or should we be making big moves? And then what should those moves be? Credit line decrease, pulling out of acquisition, doubling down on collections. So maybe starting with you, Eric, what do you think people should be doing now? Should it be more tweaking or big moves? And what from your experience are the levers that matter and those that people do but maybe don't matter as much?
Yeah, way we've been positioning it is the analogy of like a car. So your models are like your engine. Your strategies, that's kind of like your transmission, and then your credit line decreases and your account like inactive closures is kind of like the brakes. And I think people want do the one thing and it's going to make it better. And the advice we give people is, and you know, back to your original point, Richard, is like the bad loans are on your book, and so your car needs maintenance constantly, and each thing needs to be replaced at different life cycles, and you need to have kind of all of them to work together. Like you would not want to really be leaning into lending if you didn't have brakes, right? And if you don't have a good transmission, it kind of doesn't matter how good your engine is and all of those things. And so we've kind of been positioning it as if you're maintaining these regularly and have all of them, it's like a system that works together. And so it's not just tweak or pull back.
You don't have to do knee-jerk reactions.
Yeah, you don't have to
right?
knee-jerk, right? We should think about it as an ecosystem and a system that we should always be investing in and maintaining and using that to kind of navigate through. And that has really been resonating with a lot of folks. And hey, if we really want to go fast in this space, like to do that, we need to build the brakes, right? Like you never get into a race car without, or maybe you would. I wouldn't, but I'm in risk without brakes. And so people are really, that's really resonating with a lot of people right now.
Yeah, that makes sense. Richard, what about from your perspective?
Yeah, I mean, I think if you operate at the scale that Eric operates at, even small tweaks are actually fairly big moves. I think, but I would completely agree. It's not a time and a place to be making those dramatic moves. You do, the measures you already have in place. Yeah, you maybe want to, if it's, the account management pieces, you maybe want to like tighten up a little bit. See. What looked like a minor risk in a benign environment probably has a higher probability of turning bad on you in a bad environment. So it's all of those little pieces. I think to Jeanot's point, growth companies also need to be aware that there is an opportunity here. So for very sensible reasons, large players like Eric's are probably going to be tightening up and being a little more cautious. With the right approach, that is an opportunity for those of us who are trying to grow and trying to fight for market share from a very different position to be willing to offer that. We do have a more accommodating risk box than Royal Bank does. And therefore, as customers who in the past Eric would have been happy to lend to, and at the current environment, they maybe fall on that borderline where he's a little more cautious. That's absolutely an opportunity for companies like Neo and Karoo. We better make sure that we're doing that in a sensible way, but I think I wouldn't want to miss that opportunity. And right. Of course, the other point is, Eric's quite right. It's a great time to gather bad data. You're gonna need to build models in the next few years. You're gonna want some bad data to build those models with. Well, there's no time like now for gathering bad data.
Yeah, absolutely. You mentioned buy box. That reminds me, Jeanot, you guys are talking to institutional lenders and that. How are they viewing where we're at in the cycle right now, and what's their perspective? Are they being more cautious? Like, what's their perspective to where we're at?
Yeah, it's a bit of an interesting time because I think on one side they are being very cautious. They're definitely cognizant that the economic environment that there are big risks around over the next few years. We actually spend a lot of time interacting with private credit funds. They tend to be the players that fund kind of early stage fintechs on the asset side. The funny thing there on that side of the coin is that they also raised loads and loads of money over the last few years and are pretty keen to deploy it. And so I think it's not like in 2022, 2023 when you had the post-COVID shock, the market completely dried up for kind of people who are reliant on capital markets. But I would say now people are cautious, but it's much more constructive.
Right, that makes sense. We've got such a great panel here. We've got a few minutes left. I'd love to open it up to the audience for Q&A if anyone has any questions. Gary's got one? Yes.
Just go. Oh, no? Yeah, it's on.
Thank you. Hi, everyone. Thank you for your time. I'm just curious, with all the industries, all the financial institutions kind of preparing for this downturn and balancing risk, how do you balance lending and risk and not pushing consumers to some more like high interest lending loans where it might not be impactful to their current situation? We're just seeing a little bit more like unlicensed payday lending, like those kind of pieces that are coming up, and would love to kind of understand your perspective on how do you kind of balance the two there.
That's a fantastic question. Who wants to go first there?
I'll go first. I mean, I think, to my point, I think it is an opportunity for those of us who are prepared to take on a little more risk to, you know, where those opportunities exist. I think the issue of the Canadian industry not providing enough access to credit to people who need it, with the result that they end up going to unlicensed lenders. I think that's an industry issue, and it's primarily a regulatory issue, because that's really about, you know, it's not the individual companies who are pushing people into these places. It's that as an industry as a whole, we don't have the risk appetite overall to provide those people with a solution. You know, I will stay off my hobby horse about the structure of the Canadian industry, but I'll just say that I think the onus is on the regulators. If they are concerned about people ending up with unlicensed lenders, they need to look to the regulation that would enable organizations like mine to lend more deeply and more broadly, given, you know, current cost of borrowing legislation and those sorts of pieces.